Hey there, welcome back. Today we're talking about gold, what it really is, why it's been on such a strong rise this year, and how you might want to approach investing in it. Gold has always been seen as something solid, a store of value, and a hedge against uncertainty. But there's more going on with gold right now than you might expect. In fact, 2024 is shaping up to be one of the best years for gold in decades, driven by a mix of global events, market shifts, and what some call de-dollarization. Now, whether you're curious about the reasons behind gold's recent surge or you're looking for ways to invest, we'll go through all that and more. First off, let's talk about what makes gold so special. Gold has always held a certain allure. Unlike paper currency or other assets, gold has been a trusted store of value for thousands of years. And even now, in times of geopolitical tension or market uncertainty, it's often the go-to safe haven for both governments and individuals. What's really interesting is that as of October 2024, gold has gone up by around 33% this year alone. That's huge, especially when you consider that bond markets are struggling. Some experts have been saying, sell bonds, buy gold, pointing out that while bond yields are being impacted by rising interest rates, gold has been gaining strength from this environment. Now let's get into why gold is doing so well. You might think it's all about inflation, but actually inflation isn't the main driver this year. Instead, the recent surge in gold's value seems to be tied to a few unique factors. For one, there's the increase in global geopolitical tensions, especially with countries shifting more of their reserves into gold. This is sometimes referred to as de-dollarization, where countries are diversifying away from the US dollar. So, gold is not only a hedge against inflation, it's also a hedge against economic sanctions and global instability. And with central banks around the world buying up physical gold, that demand is driving prices up even further. Another reason gold is gaining attention is due to predictions of further growth. Some analysts, for instance, expect gold prices to hit $3,000 an ounce by December 2025. This forecast stems from increased demand for physical gold, especially from central banks, and from a growing number of investors moving their money into gold-backed ETFs. So if you're considering adding gold to your portfolio, it's worth knowing that there are different ways to invest, each with its pros and cons. Let's look at some of these options. First, there's the most straightforward approach, buying physical gold. This could be in the form of gold bars, coins, or jewelry. The upside of owning physical gold is that it's tangible. You have it in your hand, and it doesn't rely on any digital system or intermediary. Coins like the American Eagle or Canadian Maple Leaf are highly popular because they're easily recognizable and very liquid, meaning you can easily sell them if you need to. However, there are a few things to keep in mind with physical gold. You'll likely pay a premium over the market price when you buy, and you'll also need a secure place to store it. Some people opt for home safes, while others use secure depositories, which may come with storage fees. If you're not keen on storing physical gold, there's another way to get exposure: gold ETFs. These are funds that track the price of gold and allow you to buy shares that represent a portion of physical gold holdings. Popular options include SPDR Gold Shares, GLD, and iShares Gold Trust IU. The advantage here is convenience. You can buy or sell your shares easily through a regular brokerage account, and there's no need for storage. But keep in mind that ETFs do charge a small management fee, and the price can fluctuate with broader market conditions, not just the price of gold itself. Still, for many investors, gold ETFs offer a good balance between security and ease of access. There's also another option that's a bit different: investing in gold mining stocks or ETFs that hold a collection of mining companies. Now, this route can be quite profitable, especially when gold prices are rising, as it boosts the profitability of mining operations. For example, VanEck Gold Miners ETF, which includes stocks from major mining companies, has been up significantly this year. But here's the catch: mining stocks come with their own risks, including company management issues and operational challenges. So while they can offer higher returns than physical gold or gold ETFs in a strong market, they're also more volatile. And if you're wondering, is this the right time to invest in gold? Well, that depends on your personal financial goals and risk tolerance. Gold tends to perform well when there's uncertainty or instability, which makes it appealing as a safe haven. But it's also essential to remember that gold doesn't generate income. It doesn't pay dividends or interest. It's more about capital preservation and risk management. Many financial advisors suggest having a small portion of your portfolio in gold, perhaps 5% to 10%, to help balance risk. So, if you're looking for a way to hedge against market volatility or political uncertainties, gold could be a sensible choice. But, like any investment, it's important to consider your broader strategy and not put all your eggs in one basket.